Hello and welcome back to our channel. In today's session, we will be diving into accounting for contract cost. So, what are contract costs? Simply put, these are the costs that are incurred to obtain or fulfill a contract. We will break this into two key types. One, costs that are expensed off immediately in the P&L, and two, costs that are capitalized as an asset and written off later. Let's break it down with clear practical explanations and insights. First, let's talk about incremental costs. These are the extra costs which an entity incurs solely to obtain a contract. Meaning, if the contract wasn't secured, these costs wouldn't exist. A prime example would be sales commission. So, how do we account for them? Well, the rule is very simple. If an entity expects to recover these costs, they should be capitalized as an asset. However, if these costs would have been incurred even if the contract had not been obtained or fulfilled, they should be expensed off immediately. Additionally, a practical expedient allows companies to expense these costs immediately if the expected amortization period is 1 year or less. For example, a software company pays sales commission to a salesperson for securing a new client contract. Since this cost would not have been incurred if the contract had not been obtained, it is capitalized as an asset and amortized over the contract duration. However, if the expected amortization period is 1 year or less, the company may choose to expense it immediately. Now, let's move on to costs to fulfill a contract. These are the costs that directly relate to a contract and must meet three key criteria. One, they must relate directly to a contract or an anticipated contract. Two, they must generate or enhance resources that will be used to satisfy performance obligations. Three, they must be expected to be recovered. If the costs meet all three key criteria, they are capitalized as an asset and systematically allocated over the contract period. However, if they fall under IAS 2, which applies to cost related to inventory, or IAS 16, which applies to cost incurred for acquiring or improving property, plant, and equipment, then those standards take precedence, meaning the costs are accounted for according to their specific requirements. If the costs don't qualify for capitalization, then they must be expensed off immediately. For example, a construction company wins a contract to build a commercial building. Before starting the project, it incurs costs for designing the structure and obtaining site permits. Since these costs are directly related to the contract, they can be capitalized as an asset and allocated over the contract period. Certain costs must always be expensed immediately. These include general and administrative costs unless chargeable to the customer, wasted materials and labor that were not reflected in the contract price, costs that relate to the past performance, costs that cannot be linked to a specific obligation. For example, a manufacturing company enters into a contract to supply custom machinery but ends up wasting significant materials due to a design flaw. Since these wasted materials were not part of the contract price, they must be expensed off immediately. If contract costs are capitalized, they must be amortized systematically as the related goods or services are delivered. The amortization schedule should reflect the timing of transfer to the customer. For example, a software company incurs rupees 5 lakh in development cost to customize its platform for a major client's long-term contract. Since these costs relate to future services, they are capitalized and amortized over the contract period. But what if the expectations change? If the expected benefits from the contract declines, an impairment test must be performed. If the assets carrying amount exceeds the expected consideration from the contract, an impairment loss is recorded. For example, a telecom company capitalizes customer acquisition cost for long-term contracts. However, due to an unexpected market shift, many customers cancel their contracts early. Since the company will not recover these costs, it must record an impairment loss. And yes, if the conditions improve in the future, previously recognized impairment losses can be reversed but only to the extent of original carrying amount net of amortization. To wrap up, contract costs are either expensed immediately in the P&L or capitalized as an asset and amortized over a period of time. Incremental costs are capitalized if they are recoverable, while costs to fulfill the contract must meet specific criteria to be recognized as an asset. However, if the asset value declines, an impairment loss is recorded. Keeping these principles in mind ensures accurate financial reporting. Thanks for watching. Drop in your comments or questions in the comments section below, and let's catch up in our next video.